Well, hello everyone. My name is Jeffrey Kennedy. Happy Thursday and welcome to the very first Traders Classroom live event for 2019. Well, I'll just start off by saying, wow, I think we've actually broken a record as far as attendance to the actual live event this morning. I've got a massive number of people in the room, which is awesome. But the unfortunate thing about that is we have so many people, I know I'm not going to be able to get to everybody's questions at some point. I see a lot of familiar faces in the room, so let me just give a few shouts out here. Mr. Bill, it's always a pleasure. Jane, thank you for joining me today. Susan, awesome you could make it today. We got to catch up and talk about the big D. Umberto, I see you're with me today. I hope the book's going well. Just wow, I have a lot of people in the room, a lot of new faces as well. So that being the case, Ignatius, it's always a pleasure. Thank you. Bernard, hello. Well, let me go ahead and just, for those of you who are new and have never been to one of my live events, the rules are fairly simple. We have no rules. But first, let me get through my presentation before we start asking questions. Once I'm through with my presentation, I will open the floor for questions. And as far as the questions goes, anything goes. We can talk trading, we can talk Elliott, we can talk markets, we can talk whatever you want to talk about. That's what I love so much about having the live events once a month, because it really gives me an opportunity to talk to you, talk to my subscribers who are awesome, my favorite people. But also, too, it allows me to interact with you, I think, on a more personal level, which is very, very important to me. So let's go ahead and get started. And Kevin, thank you so much. Let me go ahead and get started. Today, we're going to be discussing something that I developed, back around 1999, 2000, 2001. And I've come to call it the Kennedy channeling technique. And it's basically just like a trend line technique I developed to help me answer a very important question. And it basically originated from a question. For example, if you're working an advance, and we'll just call this 5 waves up, and then we have our 3-wave decline, and then we have another 5-wave move up, okay, here. Now, there's 2 wave counts, 2 applicable wave counts from an Elliott wave perspective, which are applicable at that stage of the game, because it's a 5-3-5 pattern. And that could be waves 1, 2, and then another wave 1 here. That's totally applicable. Or it could be this. It could be just a straightforward zigzag where you have waves A and B, and then wave C. So on one hand, this formation is very bullish. You know, the 1-2-1, you see a small pullback and then you just go to the moon. On another interpretation, this is A, B, C up and done, and you're going to see a massive sell-off. And I always kind of struggled with this. Certainly if you have say a subconscious or a conscious bias, it can skew your analysis or what you would go to. And so ultimately I developed the Kennedy channeling technique in an attempt to help me actually aid in answering this question, because what I've observed is that price action, which is contained within parallel lines, more often than not, is going to be a counter trend move. So at this stage of the game, the most appropriate interpretation is actually ABC. Now, if this advance begins to substantially move above what I call the upper boundary line of the base channel, then the most appropriate labeling is going to be 1, 2, 3. So let me go ahead and get started. I just wanted to kind of, give you a little history on how and why I actually developed the actual technique. Now, what we have here is what I just simply refer to as a standard corrective price channel. It's a 3-wave move. 3-wave moves, again, more often than not always. As I mentioned earlier in the week in one of my commentaries, absolutes and financial markets, they don't seem to mix well. I can always find an exception to the rule to whatever indicator, whatever seasonality trend. It doesn't matter. There are things which have a high degree of reliability, but as far as 100% reliability, day in, day out, week in, week out, year in, year out, that I have yet to encounter. So there will be exceptions to this. But again, more often than not, what I find is that counter trend price action tends to be contained by parallel lines, and I call the parallel lines my corrective price channel. Now, with that in mind, because this idea, this concept really is the cornerstone principle behind the KCT technique, the Kennedy channeling technique. If this is indeed the case, then price action, which is impulsive, is not contained by parallel lines. And that's the key, because a lot of times when you're looking at a price chart for the first time, what foot you begin your wave count, and when I say what foot, the initial question, because remember, the wave principle, it provides, of course, a context for market analysis, and it does so by classifying price action into two specific modalities. You've got motive waves and you've got corrective waves. Well, that initial decision, am I going to look at price action from, say, a motive wave perspective, or am I going to look at that price action from a corrective wave perspective? Those two questions, or that one question, can either lead you down the right path or it will lead you down the wrong path. And the farther you go down the wrong path, a lot of times the harder it is to turn around. So these are just two very important slides. I'll put them side by side here because, again, this is what I look at. This is one of the primary tools I use to identify wave patterns or trading opportunities with what we talk about in Trader's Classroom, or if many of you are, or some of you I know are subscribers to my sister service, Commodity Junctures, you know that I utilize this extensively in that service as well. There are some, say, nuances or things I would like to mention regarding the KCT technique that I see, that I get frequently. Oh, here's what it looks like in a bear market. So this technique, this KCT idea, it works in bull markets, it works in bear markets. It really doesn't matter. Again, and if it didn't work, I wouldn't be using it. And again, I've been using it for pushing, what, this is 2019? Wow, almost 20 years now. So let me show you some nuances. And what I mean by the nuances is, one question I get quite frequently is drawing the corrective price channel. Whenever we're drawing that corrective price channel, when the operative corrective structure is either a zigzag or a double zigzag, it's fairly easy to identify the corrective price channel. All you do, and let me just go ahead and redraw these lines so you kind of see me do it in fact, I got a bunch of charts which I do not have labeled, and I'm going to be walking you through, showing you how I apply the technique. Start off by beginning with the origin of wave A, go to the extreme of wave B, simply take a parallel of that line, and then you'll drop it down to the wave A extreme, and then this will give us an idea of where support for wave C is likely to come in. Conversely, if we're working say a bear market rally or a zigzag to the upside, you start at wave A, go to the extreme of wave B, take a parallel off the wave A extreme, and again, I'll be looking for prices to reverse or tap out somewhere near the upper boundary line of the corrective price channel there. The operative structure here in this case would be zigzags, both of them. So again, drawing the corrective price channel when the operative pattern is a zigzag, quite easy. How do you draw the corrective price channel when the operative pattern is a flat or an expanded flat? This is one of the primary questions I get regarding the KCT technique and the idea or the concept that counter-trend price action is indeed contained within parallel lines. Well, you do this very carefully, but I'll show you how. You start off with the origin of wave A, and then you go to either the extreme of wave 2 of C, that's wave 2 of C, and then drop your parallel down. And then that lower boundary line, again, will ideally offer support for your wave C pullback. Or another technique that you can draw is you utilize the extreme of wave 4 of C. In which case, too, this brings up another finer point of the technique I would like to mention. Okay, if we go back to the original trend corrective price channel that I draw on the flat here, I start off again at the original wave A, and I go to the extreme of wave C of 2, down to the wave A extreme. Then ideally prices fall to that lower boundary line, bottom out, and then reverse. This is what I'll be showing you shortly. This is what I refer to as a bottom line reversal, okay? Now, if we utilize wave 4 as our secondary pivot, wave 4 of C, take the parallel off the wave A extreme, then this would be a center line reversal, okay? And also, too, don't be afraid to draw more than one line. So now you've got basically two trend lines drawn very strategically that ideally will identify, say, support for your market, and ideally a place to be looking for a potential or a possible reversal of trend. That's what this slide essentially shows. Again, this is a bottom line reversal right here over to the left. And this is what I refer to as a center line reversal right here. Now, whenever the bottom line reversal occurs, many times what I look for as far as, say, initial confirming price action that the structure is complete would be price movement above the center line of the corrective price channel right there. Once we get above there, then I start maybe being a little bit more aggressive as far as, okay, hey, we got above that center line, we've done so in 5 waves, then yes, maybe this is indeed a tradable low. Now, that doesn't mean we're out of the woods. This could evolve into an X wave, or this could evolve into a larger flat, but usually once you reverse from that lower boundary line of the corrective price channel and form a bottom line reversal, again, this often acts as initial evidence that the entire corrective structure is complete. If you see a center line reversal, which is the diagram on the right, then I'll be looking for prices to move above the upper boundary line of the corrective price channel, and then that again will act as initial evidence that this larger counter trend move is indeed finished. So keep that in mind as far as utilizing the KCT technique. These are some very common questions I receive from many of you regarding the KCT technique. How do you draw the corrective price channel if you're working something other than a zigzag, in this case here, a flat or an expanded flat? How you draw the corrective price channel when the operative pattern is a triangle? Well, that's kind of simple. You just it's 2 horizontal lines. There's no magic there, okay? Just FYI about that. So there we go. So we have like A, B, C, D, E, you know the point. Okay, one more point here, one more observation I would like to share and offer. I've noticed this on a number of occasions when working with a 1-2-1-2. Now, the reason we like 1-2-1-2 is because it gives way to a very sizable move up in wave 3. And that would be the second wave 2 I've noticed, tends to reverse from at or near the center line of the developing base channel. So keep an eye on this formation. So let's just kind of play with this diagram here for a moment, and let me just move this over here. We'll take that off. And here I just want to show you how I work with this from, say, a trading perspective, and then we'll look at some real-time price charts here. Okay, so we're skipping along. Okay, I got my 5-wave move up, I got my 3-wave decline. What's the most appropriate labeling at this stage of the game? Well, the only labeling that I believe you can make a solid argument based on evidence that this is at this stage of the game is this: A up, B down, and you're working wave C. Okay, prices go up to the upper boundary line of the corrective price channel. This really is, in my opinion, the only wave count which again is applicable and supported by data. Okay, now prices move down here to the center line, and I begin to see a reversal in price. Okay, at that point, now we have the question come into play that this could be absolutely 1, 2, and then another 1, 2. And then once prices begin moving above that upper boundary line right here, and you start trading, say, 255 in this case, then at that point, you actually have price evidence which supports this interpretation. And also, too, it clearly identifies the risk being where the interpretation is no longer viable, and that would be the extreme of wave 2. So your risk essentially is this point right here in anticipation of a much larger move, because once you have 3, you still have 4, 5, and then another 4, 5. So that's how I utilize it. Let's go through some price charts. And then I'll open the door for some questions here. Okay, why do I like Becton, Dixon and Company? I don't even know what they do. It doesn't matter. I understand technical analysis. I know how to read a price chart. I say this quite frequently in all of my work. Technical analysis is a language, okay? The more you understand the language of technical analysis, the better you'll be able to understand the narrative of the markets, okay? And just as we have multiple languages, there are multiple languages when it comes to technical analysis. For example, candlestick analysis is a language. Point and figure analysis is a language. Wyckoff is a language. Indicators and oscillators, these are all languages, okay? So it also pays to be somewhat bilingual. And if you're familiar with Trader's Classroom, you know that I like to utilize more than just a single simple tool, Elliott. I like to utilize other forms of technical analysis in order to build a compelling case. Now, what I like about BDX here is I've got a 3-wave move contained within parallel lines, okay? We fell below the lower boundary line of the corrective price channel right here. Okay, am I stressed about that? No, not at all. Seeing a little bit of travel through that that lower boundary line is not an issue for me, just so you know. I got a 3-wave move down contained within parallel lines. I'm loving this. And as I mentioned earlier, because we essentially reversed from this area here, this is a bottom line reversal, then movement above the center line pretty much gives me the all clear that I can say, okay, hey, this 3-wave move is down and done. I'm now going to be looking for something to the upside. Okay, now remember, we can break this down too. This is daily chart. So we can now look at this chart utilizing the KCT technique and come up with a very viable interpretation, again, supported by evidence. We're not guessing here. Guessing doesn't work. Okay, I like this as an ABC decline in Becton, or yeah, Becton, BDX. Now at this stage of the game, is there anything else I can do that would support a bullish interpretation? I believe so. All we got to do is bump it down to the 60-minute time frame and clean up the chart. And then what we now begin to see developing is penetration of the upper boundary line of the what was once a corrective price channel, but is now best identified as waves 1, 2, and 3. Why and how, or can we be confident that this is a wave 3 price move? Because the structure is no longer contained within parallel lines. Now, at this stage of the game, the most likely interpretation is that this is ABC, okay? Now, to get confirmation that your ABC is indeed up and done, what has to happen? Well, we need to fall below that lower boundary line of the center line, excuse me, of the corrective price channel. Remember, that was my confirmation point, or it would be something that would act as initial evidence that the ABC structure is indeed complete. What happens? We never fall below that, and now we begin to start trading well above it. So now I've got the 1, 2, 3 to the upside. What can we do? Well, I like to utilize my reverse Fibonacci technique. take the most immediate swing low. Now I've got objectives here, 231, 241. If things get exuberant, maybe 256. We move higher. There we've hit the first target. Now as far as structure, probably 1, 2, 3, maybe working a 4, pop up a little bit higher, finish up 1, 2, then 3, and then pull back in 4. And you can kind of see the sequencing. But price action up off the December low in BDX is now taking on more impulsive characteristics than it is corrective characteristics, which is exciting because that whole analysis supports the larger narrative that this is indeed a three-wave decline off the October high. Let's try this again. Okay, now we can approach this price chart one way, okay? Let's do this. Let's just have some crazy fun. Okay, one down, here's the high, one down, A, B. I can maybe make that a ending diagonal for a C wave. Let's call that wave 2. And then we come over here for wave 3. And then we can do this for wave 4. Okay, wave 4 does not end in the price territory of wave 1. It does overlap the B wave extreme of the expanded flat in the wave 2 position, which is really what's most important. Remember, the rule says wave 4 may never end in the price territory of wave 1. Well, all the price action from that May low to that wave 2 top, that's the price action of wave 2. Sometimes wave 4 can and will enter into the price territory of wave 2. That's just a note if you want to write that down. So let's go back to this interpretation here. Okay, and then we throw a 5 on this sucker right here. How many of you like this wave count? You see this as viable? Any problems? Susan, my #1 A+ student. Jerome, we're going to have to talk, brother. No. RJ, it's good to see you. Hello, Tim. No, John. No. What I've just done, everyone, please, this is a great example of how not to apply the wave principle. Okay, first of all, Jane, you're exactly right. Okay, what's wrong with this wave count? Okay, now, if I'm bearish, I could easily come up with this interpretation and I could probably sell it. But if you look at it from your own perspective, because remember, the purpose of Trader's Classroom is to teach you to do this on your own. So ultimately, at some point, hopefully in 2 years, you don't need me anymore because you're confident in your own ability, okay? I'm trying to get you to fish. Rather than giving you a fish, which is why I don't do specific trades, I want to teach you how to fish so you can feed yourself for years and years and years to come. That's what I love about Trader's Classroom. Okay, a couple of big blatant errors here. This move, wave 5 to the downside, it consists of 3 waves, okay? Don't like that. Also, 2, the proportion between wave 4 and wave 2 really out of whack. This is what I call a clown shoe wave count. Remember, proportion, the guideline of the right look is very, very important. Okay, so rather than get caught up in the details, why don't we just simply do this? Off the high to the extreme from the low, guess what? This is a counter trend price move. Okay, 1, 2, 3, A or W, A, B, C, X, and then A, B, C to the downside. I'm not really worried about that sell-off here, but this movement to the downside is much easier contained within parallel lines, more so than anything else. So I'm liking the idea that this is indeed a counter trend price move and that subsequent price action is a developing impulse wave. That probably is a centerline reversal there off that extreme here. Have fun with the trend lines. Hey, if you're not having fun doing this, people, you're doing it wrong. Okay, so you got a little bit of a centerline reversal right here. That looks good. I'm liking the upside. I think this is a counter trend move because, again, it fits best within corrective, within parallel lines. Okay, we'll go off that extreme. There we go. That's nice right there. Now, this is also worth mentioning. If there's any kind of play or throw over or throw under, like with this top portion right here, don't worry about it. because markets tend to seek balance, and often I see that whatever we exceed or whatever throwover occurs above the upper line here often will cap the bottom. So basically the distance here is equal to the distance here. Markets seek balance. Balance is what life is all about. The sun balances out the moon, women balance out men, cats and dogs living together in peace and harmony. Oh my God. VIPs. Okay, what do we have working here? What do you think this interpretation is with what we've, Ian, yeah, double zig, you got it. Okay, now we could play the game where this is A, B, C, X, A, B, C, and be bearish, but remember, if it's A, B, C, X, A, B, C, if there's one takeaway I want everybody to embrace today is that counter trend price action tends to be contained within parallel lines, because this over here, GD, General Dynamics. This looks like a WXY, an ABCX, ABC. But notice too, it's contained within parallel lines. The structure that we have developing in VIPs, this is so far appears to be demonstrating or exhibiting the characteristics of an impulsive structure. Remember what I said earlier about a 1-2-1-2? Many times that second wave will respect and reverse from at or near the center line. So really in this case here, this looks like 1-2-1-2 working wave 3 to the upside. So this might be something to watch moving forward. Let's look at Roku. What's the wave count? ABC up and done. Well, here's some tricks. A gap right here. Price gaps, acceleration gaps such as this, I hope everybody has learned by now, this tends to occur in wave 3 of a price move. What else can we look at on the price chart that would support a wave 3 identification of that advance? Well, look at this. We're decisively above the upper boundary line of the base channel. Okay, that confirms the presence of third wave price action. And if this is a wave 3 price move, then that means this is a 4. A secondary value or purpose of the base channel is that it tends to provide support for fourth waves, as it has in this case. In other words, we need one more move up here, and that will be our 1, 2, 3, most likely a triangle 4, 5, popping up. So on a short-term basis, I think it's a no-brainer to look for another pop-up above 44, 48 in Roku. Now notice on some of these charts here that we're working. Roku, where's the wave? I mean, where are the labels here? Well, there are no labels. There's no labels in VIPs. There's no labels in GD. There's no labels in BDX. This is why I love the KCT technique. It's a simple approach that can allow me quickly and confidently allow me to identify the difference between impulsive price action and counter trend price action. We talked about Starbucks earlier, I think in the month. I'm kind of liking Starbucks to the upside here. I like the fact that we have that price gap, wave 3, pullback in wave 4. We're seeing prices respect below the center line of the developing base channel. Now, all of this, in my opinion, would go out the window if we see prices fall below the lower boundary line. I don't really like to see price action fall below the lower boundary line when I'm working an impulsive structure, like for example, going back to Roku. I would probably abandon the idea that that's a 1, 2, 3 triangle 4, 5. If for whatever reason we saw Roku fall below that lower boundary line of the base channel. So this trend line here is really what's most important right there. Okay, same thing with Starbucks. Now, I like Starbucks. I'm liking it to the upside, but really, you know, it's anybody's guess, really, because I believe later today or after the markets close, we've got earnings. I mean, if this is indeed correct, sometimes it is, sometimes it's not. I'm not sure when earnings come out on Starbucks, but if we can, I would probably say hold some of these prior swing lows here. I'm still looking a bit higher in Starbucks. And let's look at another more. Oh, WWE. This is one that we talked about the other day in Trader's Classroom. Why do I like it? Why am I bearish WWE? Well, the move up is contained within parallel lines. If we can now get some good price action below the lower boundary line here, I think we got a lock. Same thing with the Medtronic. We talked about that the other day as well. This is the origin of wave A. Here's our ABC for A, ABC for B, 1, 2, 3. We've got a small truncation there in the wave 4 position. This works well for me. I don't have a problem identifying this certainly as a flat correction. It works out nice, no problems. So I'm now just going to be looking, oh, nice right there. So we have trend line support for the possible reversal in price. Now you can easily utilize this technique with anything else that you're doing with, say, for example, candlesticks. For example, if you're looking at this and you're tracking it utilizing KCT, which would ideally clarify the idea that this is indeed a flat correction, 3 down, 3 up, followed by a 5, then maybe look for, say, bullish divergence between these two extreme lows if you're utilizing, say, stochastic or MACD histogram. Or if you're working, say, a daily or weekly price chart, maybe you've got a bullish engulfing pattern or possibly a 3 inside up formation, that sort of thing. That's how well it works together. So any questions regarding, say, KCT at this point? I know I've got some videos out there that kind of get a little bit more in depth, but it's one of those, again, as a tool, you're going to have to play with it and work with it, but I find it very useful, and otherwise I would not have been still would not be utilizing it, essentially 20 years after the fact. Counter trend price action tends to be contained within parallel lines. So if price action is not contained within parallel lines, then odds are it's an impulsive structure. For example, we can put this entire flat in Medtronic into our corrective price channel. But notice too how we can actually break it down even farther and see that, okay, for example, the initial move down, bottom line reversal, the subsequent rally to the upside, popped up above it and then fell lower. And we can work the entire structure utilizing, again, very simple channeling technique. Okay, here are the questions. They're coming in, okay. Sergey, I always recommend having either using a hard stop or a soft stop, simply because a successful trading has to do it's always about risk, managing risk, manage risk. Just as a salesman, their motto is, or salesperson is, always be closing, always be closing, always be closing. For traders, our motto is always manage risk, always manage risk, always manage risk. So yes, either utilize hard stops or soft stops. Ian, how common is the relationship between C and A 1.618 multiple? It's certainly not the norm. It's not what I would typically look at. Do they occur? Yes, they do occur. But it would not be my go-to relationship. I want to see something more often than not, either a little bit above, say, short of equality, or a little bit beyond equality, say 1.236, 1.382. If it's 1.618, it doesn't negate the idea that it's a C wave, but it's maybe 20%, 30%. Susan, thank you. Okay, question from Umberto. If you use multiple trend lines, you find crossing lines useful as a time. It depends on how the trend lines are drawn, Umberto, but yes, often the intersection of a trend line, when trend lines say cross, that can be an important timing technique. I think that we do that already as Ellioticians with it when it comes to the trend lines we use to define a triangle. Like, for example, here's a triangle. I'm not going to put in the substructure here. Well, let me go put in the substructure, otherwise it'll confuse everybody. So you have your wave 3 top, you come down in wave A, and then you go up in wave B, and then you come down in wave C, and then we do waves D and E of the triangle. And then following wave E, of course, you see the triangle thrust higher. Okay, a lot of times, if you extend those that BC and that BD and AC trend line to the right, many times, not always, but many times, often, it's worthwhile paying attention time-wise to the intersection of those trend lines. Okay, Mr. Ron, let's take a look at platinum, PLA. That's for SPL207 platinum. Okay, here's platinum. Okay, okay, weekly. I don't look at platinum that often, but I will say if anybody's interested in the metals market, please take a look at the work my good friend Tom Denham does. He's the editor-in-chief of the Pro Services Metals Outlook. Does some phenomenal work. I really like the service because he also discusses the London base metals, aluminium, nickel, lead, copper, all that good stuff. I kind of like the idea that from the low here in August, 1, 2, 3, running triangle 4, 5. Subsequent price action would be, say, metals look good, silver looks good, gold looks good to the upside. That's an ABC decline. Probably ending here, and then the subsequent price move, because this drop, Ron, looks like a 5-wave structure, and I know how metals trade, I wouldn't be surprised if we're seeing something along the lines of, well, I don't want to be that aggressive, let's just go this, we'll just do this, AB, 1, because I know the metals market, a lot of times they like to run stops. It's really hard to have a tight stop if you're trading gold, just FYI. Some of you might concur with that. So you have your A up, you have your B down, and then you've got maybe wave 1 of C. I'm not sure how Tom is running the wave count, so you may want to check with him, but I'm liking this, and then we would have and this, again, this seems to make sense with what I'm seeing in some of the other metals that I tend to follow. And then we pop up. And again, what will I be looking at once prices get into, say, the 900, 925 area? Well, again, here's my corrective price channel. I want to keep an eye on that moving forward. And once we start clipping above that center line, that looks good. We've already taken out some nice trend lines. I like it. Thoughts on Gilead? Okay, Mr. Sam, let's take a look at Gilead. Okay. I like the gap. This gap's nice right here. So I'm thinking, 1, 2, gap, 3, 3, 4, 5. Earnings, be careful with that. Let's go to the weekly. Oh yeah, okay, I've looked at this. Okay, I like, just so you know, Sam, long term, because remember this is a monthly price chart, I love Gilead, okay? I think Gilead is going up. 1, 2, 3, pull back in wave 4. So big picture, long term, I like it. Short term though, I'm very confused with the short-term structure, so I've had a real hands-off approach. I'm just simply kind of waiting to see something I recognize. I could make the case that this is like A of a triangle, B of a triangle, C of a triangle, then maybe D, E, so maybe come June, July this year, we have some nice upside coming in Gilead if we do the triangle scenario. That does look a little odd because your wave A is so large. Then on the other hand, we have definitely ABC up, ABC down, 3-wave move. Maybe we just pop up, this year back above here, and this forms maybe like an ABC for WX. Big picture, long term, I like it. But because of the weekly and daily charts being somewhat obscure, I've got a very hands-off approach, and I'm not doing much of anything with Gilead. I teach this in Traders Classroom. And hopefully everybody knows it. If you can't count it, what do you do? If you can't count it, you don't trade it. It's pretty simple. Any normal relationships between W and Y? Oh, Craig, excellent question. Thank you. Question from Craig, and it has to do with relationships in the Wxy pattern. And all a Wxy pattern is, it's two corrective wave patterns joined together by an X wave. So you could have a double zigzag, a double three, which would be like two flats, X wave, that sort of thing. The relationships that we look for between C and A of a zigzag and C and A of a flat, same thing, same relationships are applicable to WXYs. So if you have a WXY, going back to what was that we were looking at that had that potential WXY to the downside? It was right before no, not FIPS. That's GD. Okay, so we're working with the idea this is a WXY to the downside in general dynamics. So the relationships I would normally look for between, say, wave C and wave A, I would look for here. And what you see is that it seemed to respect that 1236, 1382 area here. And then, of course, throw on the reverse Fibonacci. Boom, we actually have two levels to work with there, and then we've got that last little bump up. So what I'm doing right now is trying to construct a cluster of Fibonacci support. It looks like that the 236 and the trend lines provided the best support for the pullback, but the same relationships are apply. RUT, hold on here. Can it be a leading diagonal to the bottom of the S&P? Okay, S&P. Okay, let me see. S&P. When it comes to like the Russell and the S&P, well, two things really. Number one, I actually like to look at ETFs. They're just easy. Sometimes they're just easier to type in the tickers than say the cash or the futures markets for the Russell. For those of you who are interested in the major primary indices, we got a couple of guys at the office that do some phenomenal work. Of course, Steve Hochberg, Robert Kelly, Tom Prindiville. They do some extensive work in the primary indices. How to work with this? Well, on the daily chart level here in the SP, it looks like three down, down, up, down. Subsequent price action short term, I don't know. We're going to have to play this, watch this closely. Well, let's apply some of what we've learned today. Again, that's why I love Trader's Classroom, because it teaches, it's really all about teaching you how to do this. Well, it doesn't fit. I don't see that distinct breakaway. Remember, counter trend price action tends to be contained by parallel lines. And what I see here in the SPY, I can't make a very compelling case that this is an impulsive move up. I don't like the idea of the 1, 2, 3, 4, because the proportion between the triangle and what appeared to be a flat looks like 5 off the high. For the time being, I'm going to say I do not have a strong opinion here in the SPY. Let's take a look at IWM, see if I have a stronger opinion here. Now, this is more kind of like up, sideways, up, sideways, up. Both in the SPY and in the IWM, it looks like the little sell-offs we've seen recently, and this is just real short-term work, guys. This actually might be a small 5-wave decline. We are coming into the end of the month. Which is very significant. I don't know. I'm kind of looking to the downside here. I think we might be continuing lower. Let's go down to a 15-minute price chart. Okay, yeah, I can make the case that that's nice. That's more of an impulsive decline than anything else. Let's check out the SPY. Yeah, 1, 2, 3, 4, 5. I think what we've got maybe are small wave 1s or small wave A's. Going to the larger term time frame, I don't see the channel structure. Remember when we were looking at VIPs, Okay, the channel structure looks nice and is very supportive of this being a 1-2-1-2 to the upside. The channel structure in Roku looks really good as far as being able to identify this confidently as waves 1, 2, 3, triangle 4, and 5. Okay, I'm not seeing this kind of a clarity or this type of a channel breakdown evident in the SPY or the IWM, which would be the Russell. Let's check out the diamond. And this is an ETF which tracks the Dow. Again, I would probably say I'm on the sidelines here. I'm not seeing real quality, impulsive structure. Like, again, going back to Roku. Roku, in my opinion, where's that chart of Roku? I lost it. This is a no-brainer. This is 5 waves up, okay? 1-2-1-2 and VIPs. Again, it's a no-brainer. Here, I'm not so sold. I'm having a hard time trying to differentiate on whether or not this is indeed a 5-wave rally or a 3-wave move up. So remember, as traders, we often get locked into the idea that we think we got to be bullish or we got to be bearish. I got to be bullish the market. If I'm not bullish the market, then I must be bearish. This is not true. This is not the case. That is a fallacy. As a trader, you can do 3 things. You can be long, you can be short, or you can be flat, okay? And many times being flat is the most profitable position you can actually take. There are many cases in the past where I wish I had been flat, and it would have definitely been a much more profitable position than having played the market. And also, too, going back to something I said earlier, if you can't count it, what? If you can't count it, don't trade it. Okay. Let me see. Tevia. Oh, yeah, Tevia. Tevia. T-E-V-A? Yeah, Tevia Pharmaceuticals. Oh, yeah, I remember Tevia. Yes, okay. I remember Tevia. I was loving Tevia, okay? This looked great. I remember playing the sell side in Tevia. Okay, I liked the bearish. I liked the bearish forecast in Tevia, and here I'll walk you through exactly what I was thinking. Okay, I'm loving Tevia. Okay, A, B, C. Notice the slope, the advance, and then the subsequent move over here to the right. I liked it as an ABC. We talked about slope analysis the other day. I like to see the slope of wave C be less aggressive than what was experienced in wave A, as we have over here. So this counted nicely, A up, B down, followed by C. And then I remember getting really excited about Tevia because this is one of my favorite chart patterns to trade, and that is the double failure swing high or the double failure swing low. Okay, what we have here, failure swing 1, failure swing 2. So I'm looking for this sucker to fall out of bed and do so in a very emphatic manner. Okay, everything looks good. We got the big breakdown. I like it. We have what appears to be a very significant, substantial break of the lower boundary line of what would be a base channel. So at this point, I'm thinking, hey, I'm all that in a bag of chips. Say, from an Elliott wave perspective, you could probably go 1 down, A, B, C for an expanded flat 2 with wave 3 unfolding. Okay, now if that is indeed the case, our critical level, that would be wave B of the flat. Let me just go ahead and label it. So I'm thinking, as this thing is unfolding, that, hey, everything looks great. Hold on here. Let me label this. Okay, so this is what I'm thinking from an Elliott wave perspective. 1 up. Okay, there's our A. Here's our 3-wave move to a new low for wave B. This is actually identified as a running flat because wave C fails to fall below the wave A extreme. So I'm thinking this is our 2. Nice decisive break of the lower boundary line of the base channel. So I'm just like really patting myself on the back here that this is a wave 3 decline. But then we get this. Then we get this. That's a problem. Okay. Now, what could happen is when, we top out at or near current levels, come down and rally again. But I don't like the fact that this advance right here is so impulsive. There's nothing corrective about that. If this is 1, 2, 3, then I really should be seeing choppy sideways price action right here. So what we've seen in Tevia to the upside really throws, it's a fly in the ointment, okay? It's very concerning because it's the kind of price action that I should not be seeing at this stage of the game if this is indeed, say, an unfolding decline for another move to the downside. Now, considering the larger structure in Tevia, if I have a backup plan, I think what would probably be most likely is that we come down a little bit more and then go up here. Now, the reason I would probably lean toward the idea of a triangle, of a developing triangle, is because the depth of this decline, which appears to be now taking the shape of a 3-wave sell-off, that's followed by a 3-wave rally. Then we have a 3-wave decline. I'm not sure if that's an 80% retracement. If it's an 80% retracement, oh, it is. We might be able to actually call that a flat. Okay. So you have a couple of scenarios that we can be working at this stage of the game in Tevia. I think with the evidence that we've seen in Tevia up off the low and the larger structure to the downside, I think it might be prudent to say, okay, hey, we're either working a flat pattern, A up, B down, followed by wave C, in which case prices are headed back to beyond, say, 25, 26. And then at that point, we come back down again, or we simply work a triangle. Everything was admittedly going well up until about here. That move up, there's nothing corrective about that. I'm certainly not going to call that ABC. That's a 5-wave move, okay? And this 5-wave move, when and where it occurred, puts the entire larger structure under question. Stephen, that's why we do the KCT, because the KCT does help us differentiate between ABC and 1, 2, 3. Okay, more questions. Claudio, if you can, give me a question that consists of like 5 words. I don't have the opportunity to get much longer than that. Take a look at the, oh, here's a question, Colombian Peso. Well, let's do that. Let's have some fun. $USD-COP. What do we got here? No, that's the Czech Corona. $USD-COP. No. Do I got it right? COP, Colombian Peso. Let me see if I got it. Give me just a minute. And I don't seem to have it. Okay, I got that. Nope. I unfortunately I don't have access. Andre, I apologize. I don't have access to the Colombian Peso. Okay. Rich. Okay, Rich's question. What's the best time frame to start on iTrade monthly options? What's the best time frame to trade monthly options? Rich, I'm going to count waves. It's a difficult question. Okay, what to answer, and the reason why is because there's not a single right answer to many of these questions, and this is what makes trading so difficult. You know, for example, what markets do you trade? Futures, cash, currencies, individual stocks. Are we looking at fiber? This is why I don't like to do specific trade wrecks. Okay, I tend to stay away from that personally because all trade wrecks are not. It's like going to a doctor and saying, "Hey, doctor, I feel bad." He says, "Okay, here's some pills." What the hell's ailing you? Okay, it's a much more complex equation than that. How you invest with $10,000 account is a lot different than the way I trade a $100,000 account. How you trade when you're 20 or 30, what you invest in is a lot different than what I trade and invest in for someone who's 80 or 82 years old. What's your tolerance for risk, okay? Just as there is not a single best way to enter a trade, just as there is not a single best way to apply a protective stop on a position, there's not a single best way to trade options. I've traded options on a daily basis where I'm like in at 10 o'clock and I'm out at 2 o'clock. I've traded weekly options before. That didn't work out well. But I am a very active trader in options. But my knowledge in options, I know enough about options to be dangerous to myself and other people. Nonetheless, I will attempt to answer your question. When it comes to trading, what do I recommend, or how would you start? It's probably the same approach that I apply whenever I'm looking at, say, for example, my commodities. Okay, for example, let me see something I'm kind of liking here. Okay, well, we'll touch on last night's lesson where I mentioned AVGO. Okay, so first thing I want to do is I want to identify the trend, and my computer is acting up. I wanted to identify the trend of a market, okay? I'm very much of a trend trader, okay? So I'm going to always want to trade on the side of the trend. What's the trend in Avigo Technologies? The trend is clearly to the upside. So I want to be more of a buy-sider. I want to wait for these pullbacks, corrections, whether there are brief corrections or longer-term corrections. Because this longer trend is to the upside, I tend to want to favor the buy side, okay? Now, if the trend is to the downside, like it was in, say, BBY, okay, the trend is clearly to the downside. So I'm really not, the game that I guarantee you'll lose a bunch of money if you do this, is trying to pick damn bottoms all the time. The market is falling out of bed, but if you're trying to go, oh, hey, that's bullish, oh, hey, that's bullish, oh, hey, that's bullish, that's not going to work out well for you, okay? The one trading style, and I learned this by reading those books by Jack Schwager of Market Wizards. And if you haven't read those books, I highly recommend you read those books because you'll pick up some good information of the world's best of the best traders. And most of them are trend traders, okay? So, Rich, as far as how I set my mind frame up, I want to find a stock. I want to find something that's trending up or trending down. Okay, that being the case, I'm going to start off by trying to determine trend on the weekly time frame. Next, I want to move down to the daily time frame. And then at that point, what am I trying to do? On the daily time frame, I'm trying to identify a pattern. Now, I offered this as homework last night to my Traders Classroom students because I thought it was a really good brain teaser as far as being able, first of all, there's nothing impulsive about this. This is indeed a counter trend move, and I'm looking for it to be more than fully retraced. And in fact, I'm looking for prices to get significantly higher, and I'm looking for prices to moving forward up to a minimum of, say, 300. If things get exuberant, we could be looking at, say, 350. I'm loving the upside. But how do we get there from an Elliott wave perspective? Because, again, this is kind of a brain teaser. Now, I've already received a number of price charts from many of you with labelings, and I haven't seen a price chart yet. I might later, but as of yet, I haven't seen the one with the correct wave count, or what I would consider to be the correct wave count. When working with a structure like this, focus on what you recognize, okay? And we're going to piecemeal it, okay? So what we have here off the high to that low is clearly a down, up, down. That's a three-wave move. Now, that move right there is also a three-wave move, but notice where that three-wave move terminates. It terminates very near the prior swing low. There's only one Elliott wave pattern that really allows that. And so what we can now do from an Elliott wave perspective is begin to fill in the blanks. Okay, so we have our initial move down, not a 1. Okay, so we have our initial move down for here for A, probably A, B, C, D, each small triangle right there for B, and then we have C. Then we have our 3-wave move up for wave A of our flat. Up, not an A. Hold on, let's go back. There we go. And then we have wave B. Let me put that A in the right position. Okay, and then we've got wave C right here. That works, 1, 2, 3, 4, 5. Okay, so we have an ABC. So now we can start going, okay, well, I've got multiple corrective structures. I have to call this an X because the problem is this decline doesn't count as a 5. You just basically have down, up, down, okay? So that would mean we would have to put a Y here. Okay, well, the problem with that is notice the proportion between W and Y, and certainly X, okay? It doesn't work. Well, could we just go ahead and say 1, 2, 3, 4, 5? Well, you could, but the problem with that is this move down is down, up, down. That's a 3-wave structure. Here's the trick. This is why I think this price chart is the brain teaser. It's in your book. It's a very rare pattern. It's a combination, and it occurs whenever wave Y of a corrective combination takes the shape of a triangle. Very rare formation. I've only seen probably about a half a dozen in as many years, but it is a legitimate pattern. There's an example of this pattern in the book written by A.J. Frost and Robert Prechter, which is a must if you're going to utilize Elliott as a tool. So here, but again, I thought this chart would be fun for you diehard Elliotticians because it's really a brain teaser. I had to actually spend some time with this price chart. And then if that is indeed the case, nice impulsive advance, nice 3-wave decline, come down, close the price gap, looks good. So that's how I would count Avogo. And moving forward, of course, looking for further rally, identify this whole structure here as a 4th-wave move. And then what you can do, Rich, is move down to your smaller term time frames and then utilize those smaller term time frames to identify possible entry points or protective stops, identify your risk. But really, I'm going to throw the question back at you. Who are you as your trader? What's your risk tolerance? What markets do you like to trade? You have to, nobody can answer these questions. I can't answer these questions for you. You have to kind of figure this out for yourself. Oh, yes, by the way, yes, Rich, yeah. The Market Wizards books are available on audio. I drop them on my Audible and absolutely love them whenever I'm looking at them at the gym. Okay. Rich, if I can help with anything else, please drop me an email. Guys, we're a little bit beyond my time. I hope everyone enjoyed today's live event. I hope that hold on here. Hold on, Christian. Whoa. Don't everybody leave yet. Christian, are you still with me? What's your question? I'll take one more question and then I'll wrap it up. Again, the reason I wasn't able to answer a lot of the questions today is because I've got a number of people in the room, much more than normal. Okay, KCT. Let me see. Okay, well, let's try and work with the Roku price chart here. Okay, we know at this point, follow me, Christian. Okay, we know with that decisive gap up above the upper boundary line of the base channel, that the most appropriate labeling is going to be impulsive. Let's just use small letters, 1, 2, 3, and 4, and 5, okay? So let's just go ahead and call that 1 up, running flat wave 2 right here. And then this puts us in wave 3. Okay, so we have our wave 3 top. Okay, so now we're going to be entering into our wave 4. Now at that point, what we can do, sorry about that, guys. What we can do is with, say, this is one of my favorite pages. We're looking at Roku, 60-minute. Okay, so now we're at this stage of the game. Okay, now Christian, I don't know if you've been with me that long as a Trader's Classroom subscriber, but because I'm looking at a fourth wave move, there is a specific pattern I want to see utilizing momentum. I want to see RSI fall into RSI bull market support and then begin to reverse up from the bull market support area. That's one of the ways I actually utilize RSI to identify trading opportunities in an upward trending or upward or downtrending market. For example, these are gimmies right here. RSI moves into RSI bear market resistance right there and right there, and at the same time you've got your stochastic pegged and oversold. So that's a good selling opportunity. That's a good selling opportunity. Just as price action and wave patterns, just as price forms wave patterns, Elliott patterns, head and shoulders patterns, momentum also forms patterns. Bullish and bearish divergence is a type of pattern. Okay, so really what I'm looking for is I'm looking for RSI to fall into that RSI bull market support area. I already know this sucker's a fourth wave. Now, okay, now I'm liking this right here. We see RSI bull market support, and we also have a stochastic in the oversold area. Rich, I don't know if you're still with me, but this is a time where, okay, hey, I might be willing to say buy some 35, say 40, and again, don't misinterpret what I'm saying to be specific trading advice. That's not what I'm doing here. This is all educational. But at this stage of the game, I would be comfortable saying, okay, I'll buy some 40 calls or I'll buy some 42 calls that say expire in say 4 to 6 weeks. I don't want to get cute and start trading the weeklies. Okay, prices are moving on, they're moving on. Okay, my analysis is still solid because we're still holding that RSI bull market support zone, that area between 50 and 40 right here. Okay, and then prices are moving on. Okay, now we're starting to clip up. I'm feeling good. What can we do maybe from a candlestick perspective? I like candlesticks on a bigger time frame. They simply have more meaning. Okay, we knew from our channeling technique, this was a 1-2, that was our 3 pullback in wave 4. Once we saw that bearish engulfing pattern here fail, and then that was followed by the bullish engulfing pattern that we saw the other day, that could have been a trigger, or even today's trigger here for a move up to say 46 or possibly 48. It just, Christian, it just takes a little bit of time, but you can combine these techniques. And pretty much I do this every day in Trader's Classroom, combining not only KCT, but I utilize KCT with candlesticks. I use KCT with indicators and oscillators. The value of KCT is that many times, again, it puts me in the right direction from the get-go. Looking at a structure either correctively or looking at a structure from a counter trend perspective. So, and also too, Christian, if you have any other questions, drop me an email and I'll do my best to get back with you as soon as possible. Guys, that's about it. Thank you as always. Again, I apologize if I wasn't able to get to your question, but again, lots of people in the room. Maybe I just need to plan on doing a 2-hour one time. I don't know. Maybe. We'll see. Guys, have a great day again. I hope you had a wonderful time. I hope you learned something. If nothing else, I hope you were entertained for an hour during lunch. Okay, everyone. Thank you as always. I'll see you next month. By the way, I do these every month, okay? Susan, thank you. Jane, it's a pleasure. Okay, bye-bye, everyone. Thank you, thank you, thank you.